Let me read something to you by Charlie Munger, who is Warren Buffett's longtime business partner. And Charlie says, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." And on this channel, I try to present to you what I believe are the current market conditions and the best investment information and strategies based on those conditions. And one of the best strategies I have observed over the years is to buy the most out of favor names. Another strategy, which I don't necessarily suggest, but that has worked quite well, is to short the companies that have the highest hedge fund and institutional ownership. And that combination seems to be the surest way to generate profits. One of these strategies is to invest in the dogs of the Dow, among other similar kinds of strategies of buying out of favor stocks. So, let's take a look. Bank of America recently confirmed that with just one exception, the historically unvolatile year 2017, this type of strategy has continued to be consistently profitable. According to Bank of America, over the last several years, buying the most underweight stocks by large cap active funds and selling the most overweight stocks by large cap active funds has consistently generated alpha. As Bank of America adds, the 10 most neglected stocks have outperformed the 10 most crowded stocks by an annualized spread of 8.4% on average during the first 15 days of each quarter since 2012. And again, this chart here shows that buying the 10 most underweight stocks and selling the 10 most overweight stocks by active funds has generated alpha every year in the past 5, except for the year 2017. But these strategies have been around for generations, as I certainly am not the first. This should hardly be news to the market. Surely there is a working, back-tested trading model that uses these two inputs as signals, and thus their informational value would be severely curbed. And yet, this strategy's ability to generate alpha continues to surprise year after year. And this is where it gets more interesting. In an attempt to reveal how this highly contrarian strategy generates returns, Bank of America strategists broke down the universe of most disliked stocks by both hedge funds and long-only funds. Next, when analyzing the returns of the most shorted basket of stocks by hedge funds, B of A found that those stocks which also have high crowding risk, or in other words, the popular stocks, among long-only funds lagged the market significantly, negative 12.9% versus 4.7% for the equal-weighted S&P 500. However, when looking at the most shorted by hedge fund basket, that quintile of stocks neglected by long-only funds outperformed the universe by a big margin, tripling the return of the broader market, plus 16% versus plus 4.7% for the equal-weighted S&P 500. Many of the stocks that end up in the prized most short or most neglected bucket are defensive utilities and REITs. These groups gained the most in the 12 months since March 2018, and I have focused on several of these in the past. And although I do not suggest shorting stocks, one could simply go long the most shorted stock, those shorted by the entire market, including hedge funds and mutual funds. This would not require any labor-intensive work other than merely rebalancing the trade basket every quarter, all based on publicly available information. The bottom line, by definition, there will always be stocks that are most crowded and most shorted. This is a simple strategy that is limited to those who are relatively small and nimble and can avoid moving the entire market, kind of like you and me. As a contrarian investor, you will likely be rewarded while the whales are doomed to fade into obscurity. So there's no need to chase the market. Instead, Look for those unloved gems and prosper. For today, that's ChewDog Charts. Thank you.